Hello, everyone, and welcome to our fourth quarter of 2018 market and retirement planning update. Yes, it is finally the fall. As of the date of this recording, it's been raining now for a couple of days. I don't know when we last seen the sun, and hopefully this will pass and we get into some good, nice fall days. As a kid growing up on the farm, this weather was always watched a little closer in my household just because our family trying to get crops out of the field. And needless to say, it hasn't been moving very quickly down on my family farm. So, anyways, with that, let's dive into this quarter's video. And I'm going to kind of be short to the point. This video should take probably 7 or 8 minutes. I have about 6 or 7 slides to show you. We'll review the market returns over the past quarter, talk about the changes to interest rates, talk about the continued strength in our U.S. economy, and then talk a little bit about what to expect as we come up towards the midterm elections. So, number one, market overall is pretty healthy. We haven't seen the consistent breadth among all asset classes as we saw in 2016 and 2017 this year, because as you'll see, we're seeing a little bit more disparity. U.S. large cap continues to do fairly well, as you can see up here. You can see that international emerging markets are tending to underperform again this year by actually a fairly substantial margin. Ironically, if we look back last year, they were our best performing asset class. And then we get down here, over the past really 5-6 years, we've seen very consistent positive performance across the board from fixed income. Well, now that we're starting to see some rate increases here in 2018, we're starting to see some downward pressure on fixed income, and therefore it's not supporting that side of the portfolio as it once did before. So overall, you put this together, fairly solid returns, nothing to get overly excited about, but again, we'll take anything that's positive after having these continuous up years that we've had over the last 9. So as you can see here, this is a beautiful looking chart. We saw really, if we go back to 1997, we saw a 106% increase, then a 50% decline. Then we saw a 100% increase followed by a 15% decline. At that point, most of us as investors were really ready to throw in the towel, and our tolerance for patience and just overall investor confidence was really in the toilet, so to speak. And so here we've finally seen some very significant forward progress from the bottom here, 331%, and does not look like it's slowing down. My hunch is at some point here we'll get some sort of major market correction, but that could be 1, 2, 3 years from now. I don't really know, but nonetheless, it just shows that we have to stick with this longer term, and we do go through rough patches, whether it be 5 years or 10 years along the way, and that's just part of the deal of being a long-term investor. Again, one of the concerns that we hear from all the market pundits are, the market has to be overvalued or it's worth too much on all these relative valuation metrics. And when you look at this, that's really not true. You can see right here that our PE ratio, our price to book ratio, dividend yield ratio, you can look in the upper right corner, they're really not that much overvalued relative to historical measures. And so we couple that with a low interest rate environment, we see continued strength ahead. The next thing that I wanted to touch on was the Fed funds interest rate increases. So if you're someone that's been out buying a home, refinancing a mortgage, maybe going out and getting a loan of some sort, or even just looking for better checking and savings balances or money market, you're starting to see interest rates really start to tick up at an accelerated rate. Now, keep in mind we were starting from the bare bones bottom here, but really over the course of the last 2 years, 2017 and 2018, we're starting to see, if we count that up now, 1, 2, 3, 4, 5, 6, 7 different interest rate increases, and now we've seen 3 this year. And so again, this shouldn't be a worry for people. Remember, we raise interest rates when the economy is good and strong, and markets tend to perform well in rising interest rate environments. So don't let people convince you otherwise that the increasing interest rates are bad longer term. Now, there is the point of stretching it too far, but again, we're at 2.25% right now at interest rates. So it's nothing even remotely close to the historical mean. And then I came across an interesting research report from LPL Financial that showed that, interestingly, when we look at midterm elections going all the way back to 1946, right? So we're going over basically a 60-year period, regardless of who had the House, who had the Senate, who was, president, regardless of party. 1 year following that, every single time period, the market was positive. That's 18 for 18. I mean, that is phenomenal. So this is something I'm going to be using with people as we move forward throughout the next year, is that we have to play the odds in our favor. We have to look at this and say that this seems to be fairly opportunistic and fairly solid for the markets longer term. And so in the recent, if we look at the last 3 or 4 years, it hasn't been anything overly aggressive, 4.5, 3.7, 6.7. But overall, to me, this is a very, very positive sign along the way. So no reason to sell out now. Again, there's always going to be that first time where the market does, but overall, I feel very strong at where we're at in the economic cycle. Again, just to reiterate, housing overall is really strong. We're seeing some slowdown as far as new building construction, but at the same time doesn't mean that housing and prices are recessing or anything like that. It's just as interest rates are slowly starting to peak up. Obviously, a lot of people have bought homes or built new homes over the last 5 years, and so this maybe just might be a little speed bump along the way. So in conclusion, the economy remains strong. I see continued strength. When I see things like market doing well after midterm elections and these types of statistics, to me that proves to be a strong, healthy cycle that does not require us to look or approach things differently. Unemployment continues to be very low. A lot of different people, clients that I talk to, different industries, sectors, is that overall there's a labor shortage out there in a lot of different industries, and they're really struggling to find good people. I know that may be a problem for businesses, but that is a good sign of overall economic strength. So again, political divide is at an all-time high. We don't need to get into that here, but don't let that cloud your investment opinions. Right? We need to separate those. Again, I stress patience. Just because the markets are humming along here does not mean that we always have to do something. So with that, as always, I appreciate your time. I hope that you found this short little 8-minute video beneficial, and everyone have a wonderful fall. Take care.